Good morning, good afternoon, good evening. It's great to have everybody join for this, what will be, I'm sure, a very interesting conversation on liquidity measures that are taken by policymakers in response to COVID-19 and what this has meant for the financial services providers that serve low-income people globally. So CFI is honored to have a fabulous set of panelists who I'll introduce very shortly. But before we get started, I want to just talk a little bit about the logistics. Neil, if you will move on to the next slide. So we're going against the grain. We are not using Zoom, we're using GoToWebinar. And so this platform, everybody will be muted for the duration of the session. We encourage you to please submit questions throughout. We'll be moderating the questions. We'll do most of the answering at the very end. You have to go to the questions section, click down on the little arrow, and that'll open up, and then you can submit your questions. All right, so let me just say a few words around our partners. So this CFI's policy work is done in partnership with the MasterCard Center for Inclusive Growth and GIZ, and we're very thankful to their collaboration and their partnership. So to get started with just the lineup, I want to introduce the panelists. So my name is Mayada El-Zoghbi, and I'm the Managing Director of CFI, and I'll be moderating the session. So like I mentioned, we have a great set of panelists. Let me just start with Loretta Michaels. Loretta is a senior policy consultant. She's working with CFI, and she's the one that has done the research for CFI that she'll be sharing today. And she's the lead author on the paper that just came out called Preserving Liquidity, Policymaker Responses to COVID-19 and the Impact on Low-Income Customers. So Loretta is a longtime policy specialist in the inclusive finance space. She's worked with CGAP, she's worked with Better Than Cash Alliance, GPFI, and she's also been at US Treasury. So Peter Zetterli is joining us from CGAP. He is a senior financial sector specialist working with CGAP. He is the one leading the pulse survey that CGAP has been doing in the last couple of months. Peter's been with CGAP for many years. He was based in the field in Ghana and Tanzania, leading work on digital payment ecosystem development. And most recently, he's been leading work on business model and cutting edge innovation and what that means for the inclusive finance field. Next, we have Klaus Prochaska. Now, Klaus is the head of section at the Financial Systems Development and Insurance at GIZ. Now, of course, GIZ manages the technical assistance arm or work for the BMZ, the bilateral donor agency in Germany. So again, Klaus is also a long-term policy expert in our field. Before joining GIZ, he was at CGAP, AFI, Telenor. So it's great to have him today. And then, of course, last but not least, we have Mrs. Pia Roman Tayag. Ms. Tayag is the Managing Director of the Center for Inclusion and Advocacy, which is part of the Central Bank of the Philippines that focuses on financial inclusion, financial education, and consumer protection. She's very active in a lot of global fora that are focused on policy and inclusive finance, including the G20 GPFI, a global partnership for financial inclusion. She's involved in many of the AFI working groups, the Islamic Finance Services Board, and she also supports Queen Maxima's FinTech working group. So very busy, and so thank you so much for joining us today. Let's go to the next slide. So today, this is a discussion. We want to talk. We'll start off with CFI, with Loretta sharing some of the research findings that CFI found related to policy measures on liquidity. We'll then move on and have CGAP share. Peter will share globally what the Pulse survey is saying on how what's happening to the liquidity of MFIs around the world. We'll then get into specific experience of the Philippines, hearing a little bit about what's been happening related to these issues in that market. Ms. Pia will share that. And then finally, we'll move on to Klaus, who will tell us a little bit about the role of donors. What have donors been doing in response to some of these things that they're hearing in the market? So just setting the stage briefly before we get started. So I think all of us who work in the inclusive finance space are acutely aware that the gains that we've had in the last 20, 30 years may be lost as a result of COVID-19. We're hearing a lot about how COVID-19 is impacting the lives of low-income people, micro and small enterprises around the world. We're beginning to hear how COVID-19 is impacting the institutions, the financial services providers that have been at the heart of much of the progress of our industry. So this session is really about trying to understand what are the policy measures that policymakers are taking to preempt or to reduce the impact on COVID-19 on low-income people, but also on the institutions that serve them. And we've decided to hone in on the issue of liquidity because there's been a call to action on this potential looming liquidity crisis, and we wanted to understand a little bit what's been happening on that issue. So to get us started, I'm going to hand over the mic to Loretta, and she'll give an overview about what CFI found in our research. So Loretta, please go ahead.
Thank you. So do you want to, right. So as Mayada said, we are looking at the entire universe of policy responses. And of course, these are all just high level categories here. But for this first note, we did decide to hone in on liquidity measures. If you want to go to the next one. Yeah, as Mayada said, our premise in going into this liquidity research was that the lockdowns associated with COVID as well as moratoria, we're going to have significant impacts on the financial institutions that were serving the base of the pyramid, with repayment rates going down, cash reserves going down. And the question is, are we seeing a looming financial service provider liquidity crisis? And so we're looking at this from the policy perspective. And then, of course, you'll hear from Peter of CGAP, who's been talking directly to the MFIs themselves to get the latest information from them. Do you want to go to the next one? Now, it's important to point out, first of all, that this particular crisis is often, well, let me step back. The global financial crisis of 12 years ago ended up changing or upending a number of the assumptions that we all had, many in the industry had, about microfinance. There was long an assumption that it was counter-cyclical, but of course, as we saw 10, 12 years ago, it was very clear that the higher the level of integration of microfinance into the formal financial system meant that it was suffering the same impacts as the financial system. So we can't make the assumption anymore that it is counter-cyclical. The other assumption has long been that microcredit is not systemic. But the truth is microcredit can be systemic, especially if it makes up a significant share of GDP or a large share of the total credit. And even putting numbers aside, as we all know, microcredit and microfinance institutions deal with a significant, large, generally underserved share of population. So it can not only be financially systemic, but socially it can be systemic, if we can use that phrase. So it's important going into this to take the view that microfinance, given its similarities with traditional financial institutions, needs to consider similar solutions when they face crises of this nature. Do you want to go to the next one? So what was happening with COVID? As I started to say before, a lot of people immediately tried to compare this to the global financial crisis, but economists are all saying, and policymakers are realizing, that this is much more aligned with the global depression, the Great Depression of the 1930s. We're seeing all sectors of economies being impacted all at once, and it's not just a health crisis, it's an economic crisis hitting all the sectors. We have sudden mass unemployment, which is hitting people who generally do not have sufficient safety nets. So, and of course, with severe consumer spending cuts, we're seeing a significant impact on entire global populations. So that's the first difference about this particular crisis. It's, as economists all agree, this is a regressive crisis, meaning that it is impacting the most vulnerable and the low income the hardest. Now, most of the initial economic measures that were taken by policymakers and central banks have mainly been aimed at the banks and or involve direct support, so significant G2P payments. And it's understandable that most of the economic measures, especially liquidity, would be aimed at banks because they were being led by the central banks. The other thing that is very important to remember with this crisis is that there is much greater acknowledgement and understanding of the important role of the SME sector in virtually every economy, but especially in the emerging markets that we're most concerned about. And therefore, the financial institutions that serve that market are particularly critical for reaching all of these underserved segments. Please, next one. So in terms of this particular crisis, liquidity was already very tight. We had very low interest rates already, which meant that central banks didn't have as much leeway or to play with interest rates on this. They had to start moving to less traditional tools. There was also high debt, both corporate and national debt. And as I just said, it's the customers of the MFIs and the non-bank financial institutions that are being most directly impacted by this crisis, either the SMEs or even, in those countries where the SMEs take up a significant part of the employment, those that are salaried are generally working for industries that have been shut down, like tourism, garment workers in the textile industry, et cetera. So it's these customers of these MFIs that are being most directly impacted. So what is happening to these institutions? Loan repayments are stopping or severely cut back, and of course, interest income is cut back. Those institutions that take deposits are seeing their savings withdrawn by their customers, which means less cash for operations, no cash to pay staff to collect repayments. You've got debt stress because all these MFIs are still being tasked by their lenders to make repayments. So the concern is that this could turn into a real solvency issue. CGAP itself, in one of its analyses over the last year, pointed out that a drop in repayment rates from 95% to 85%, which is not a huge portion, could render most MFIs insolvent in less than a year. So this is a serious concern that policymakers need to pay much more attention to. Can you go to the next one? So what are the measures we looked at? We looked at moratoria, central bank liquidity measures, global targeted liquidity facilities, and then guarantees. And I should point out, I should have said this at the beginning, I hope everyone watching has been able to read the report, because it's impossible in this time frame to go through all the detail, but there's a lot more detail in the report. Next slide, please. So moratoria, what's going on there? The bottom line is that while it's understandable why policymakers took moratoria actions, they have led to a lot of confusion and mixed results. The parameters have all varied, and not just between markets, but within markets, both the parameters of the moratoria themselves, as well as how they're being implemented. And that has led to significant confusion on the part of not just consumers, but the financial institutions themselves. I mean, many financial institutions were hearing these announcements at the same time the public was, and they were having to suddenly scramble to figure out how are we supposed to be doing this. And when changes were made, again, the financial institutions weren't told until it was publicly announced, and suddenly they had to set up, call centers or whatever had been promised. So there was a great deal of confusion. And of course, the MFIs were caught in the middle. This has been a real issue. The MFIs were finding that their clients either were covered by the moratoria or believed they were covered by the moratoria, and therefore felt they didn't have to pay. But the MFIs, when going to their bank lenders, were being told, no, you can't have a moratorium. So there's the potential for significant liquidity squeezes going on at the MFI level. Regulators, many that we spoke to, say, well, they have urged the banks to give the moratoria to their MFI clients, but they haven't mandated it. And banks acting rationally are very risk averse, and they have been very concerned about extending blanket moratoria to their institutional clients. Next page, please. Now, the liquidity facilities have largely been aimed at banks. As we know, the banks versus the MFIs typically in most markets have different regulators. Now, it's the central banks that have been the driving force behind most liquidity facilities. And even in some cases where the central banks have certain microfinance banks under them, they are not allowed to access those liquidity facilities, which has been interesting. And those central banks that have allowed non-bank financial institutions to avail themselves of the liquidity facilities have set criteria so stringently or so high that very few MFIs could participate to begin with. Now, to their credit, a lot of regulators have gone back and revised some of their criteria. You know, Zambia had initially wanted, you know, unsecured collateral as part of any liquidity support. And to their credit, they went out and, you know, they noticed that none of the MFIs were applying, so they went and spoke with them and discovered that, in fact, most of their MFIs did not have the kind of unsecured collateral that the central bank had specified, like government securities or commercial real estate. So they revised the criteria for MFIs to allow for unsecured loan books, shareholder guarantees, and even residential real estate when it was appropriate. And so many more MFIs have stepped up and are tapping into that liquidity support. So it's important to point out that this is a moving target. This has been a crazy year for everybody, including central banks and policymakers. So things are evolving, and those banks that are going back and trying to understand what's working, what isn't, have done a very good job of trying to adjust their parameters. So that's the good news. Naturally, unfortunately, the banks who are getting a lot of the liquidity support from the central banks are still being very risk averse. The complaint that we heard in most of the markets we spoke to is that the banks are focusing only on the large MFIs, and that they're demanding even, you know, the smaller ones and the mid-sized ones to see their repayment rates go up before they will provide liquidity support. And there are also complaints that just accessing these funds have been, you know, it's been too complicated, or that the total funds available are insufficient. So a lot of the industry observers that we spoke with say that the MFIs would much rather deal directly with the central banks. It would just make their lives a lot easier. Could you go to the next one? Global liquidity facilities. Now, the multilateral development banks, the World Bank Group, et cetera, have all sprung into action. They've been doing a lot of stuff with debt reduction, with health support, et cetera. They did put in place liquidity facilities at first, but most of those were aimed at their existing clients. They are now looking at putting together additional facilities aimed at a broader audience. I mean, we last heard that they were going to announce something about 6 weeks ago, but we haven't heard anything yet. And then there are some other donor efforts. Interestingly enough, there are some very nationally focused donor efforts. You know, EFOD is doing some things in some of the markets that it's working with to support agriculture and rural communities, including the banks and the rural MFIs. There's a donor consortium in Myanmar that is providing liquidity support to the MFIs under their remit. I do want to point out that the fact that there is not as much information as we would expect on this page does not mean it's not happening. We do know from our friends at these institutions that they are busier than ever, and they just haven't had time to update their information as to everything they're doing. So nobody email me afterwards and say, wait a minute, we're doing all this other stuff. So if you could go to the next page. Guarantees. Guarantees is in some ways simple yet complicated. And so I won't try and go through all the detail here. The bottom line is that the complaint is that the guarantees are not reaching the MFIs. These are usually offered in conjunction with liquidity facilities, and so if liquidity facilities are difficult to access, then the guarantees are also difficult. As I said, the views of the guarantees are that they're not reaching enough of the MFIs. Interestingly, in some markets like Morocco, there's been public criticism that guarantees are going to increase SME debt. I don't know that they've seen evidence of it, but there was a fear of that. So now some markets that we spoke with are doing some very interesting things with their guarantee facilities. For example, Egypt, the Central Guarantee Corporation of Egypt is providing guarantees to the MFIs along with technical assistance. And the difference this makes is significant because where the CGC is providing technical assistance to the MFIs, the banks are therefore that much more willing to provide liquidity to those MFIs that the CGC is supporting. And interestingly enough, the CGC, they say that only 4% of their guarantee activity goes to MFIs, but 70% of the clients they work with are those MFIs. So it's not financially significant on a national scale, but it is from a population and social, stability perspective, incredibly important. I think I'm going to stop there and let Peter tell us more about what they're hearing directly from the MFIs.
Thanks so much, Loretta. So yes, I want to just hand over to Peter. And Peter, obviously you're representing the voice of the MFIs in this pulse survey that you've done. What Loretta has been sharing is what we've been hearing from the policymakers and regulators, and delving deep in a few markets, but not as broad as the pulse survey. So I'll hand it over to you to give us the lay of the land now with the MFIs.
Thanks so much, Mayada, and thanks, Loretta, for her intro as well. So I'm going to speak a little bit, as we said, about what we can see about liquidity in the CGAP Pulse survey, which, if you go to the next slide, is a short digital survey that we run monthly. It's self-reported by MFIs directly. In wave one, we had about 320 MFIs or so participating. It's declined a little bit over waves, but a decent sample. We're currently in wave four. The data or high-level cuts of the data are available to the public at this dashboard, where you can see on the screen, and you can see the URL as well. It has pretty advanced filtering and benchmarking tools. So for those of you, I hope many of you checked it out already, but for those of you who haven't, please do go to that URL and check out the dashboard. We're collecting the data basically for the good of the community as a public good. So we do hope that it gets used and that it's useful. Go to the next slide. I thought it would be interesting for my talk just to sort of explore the elements that Loretta talked about in this sort of causal chain leading up to the liquidity crisis, and see what our data have to say about that. And if we start by looking at the impact of lockdowns, next slide, please. The lockdowns have actually impacted MFIs operationally less than we expected. I think we expected to hear about significant branch closures, for instance. But what we're hearing from our MFIs is that only 16% of MFIs have actually closed branches, and those that have, typically 2/3 of them have closed less than 1/5 of branches, so relatively few MFIs affected and few branches affected at those MFIs as well. When it comes to more severe staff measures like furloughs and redundancies, the numbers look similar to the branch closures, a little bit lower, but few MFIs are doing that. Small proportion of staff are affected by those measures by and large. What we're seeing more of is these softer staff measures that you can see on the right, staff working from home, staff working reduced hours, being on paid leave, and so forth. About half of MFIs are taking those kinds of measures. If we go to the next slide, on moratoria, we're pretty much seeing the picture that Loretta painted. Moratoria are very common. 2/3 of MFIs in our sample are offering moratoria or are doing more moratoria due to COVID, which is how we phrased the question, so as not to confuse it with sort of standard restructuring and moratoria that they may or may not be doing. And out of those who are offering moratoria, 1/3 say that they're doing it because they're mandated by the authorities. 2/3 are doing it on a voluntary basis, which is also interesting. If we look at the share portfolio under moratorium, we see that nearly 2/3 of MFIs have less than a fifth of portfolio impacted. That's the graph in the middle. But nearly 1 in 5 MFIs have more than 60% of the portfolios in moratorium or restructuring, which is obviously very, very high. We wanted to know what the criteria are for awarding the moratorium. And here we see this very wide range of practices that Loretta partly alluded to. The most common approach is to give moratorium to all clients who ask for one. But 40% of MFIs are awarding moratorium more selectively. Some of them are setting the criteria for that themselves. Others have the criteria set by the regulators. And about 1 in 6 MFIs are giving blanket moratoria to everyone. And the main takeaway for liquidity here, of course, is that cash inflow has dropped substantially because of this. But that is actually partly balanced out by a reduction in cash outflow. If we go to the next slide, because we also found that 2/3 of MFIs have reduced their lending. So of course, expected that would happen. I think the numbers look quite stark. What's equally striking is that they've reduced it quite a lot. So those MFIs who cut lending, 2 out of 3 have slashed it by more than half compared to normal levels. And 1 in 10 say that they've stopped lending altogether. We don't know why they've reduced lending, it's worth noting, but whatever the reason, fewer disbursements, of course, means that they are retaining liquidity. So that counterbalances the impact of the moratorium. When it comes to loan losses, if we go to the next slide, we see write-offs haven't really started in earnest yet. 1 in 10 MFIs say that they're doing more write-offs due to COVID. And for those that are doing write-offs, we can see the write-off ratio to gross loans here on the right. For the first 4 months of the year, it was 1.1%. For the first 6 months, it had risen a bit to 1.4%. So there is an upward trend, clearly, but the numbers are still pretty modest. And I think that's to be expected. We won't really see write-offs take off until the moratoria are expiring and those restructured loans come due. But the net result, next slide, please, of all of this is that the liquidity picture is actually better than we feared it might be, and possibly even better than it was before the crisis, which is slightly surprising. On the left here, you see a graph by Daniel Rosas that he did on 2016 data pre-crisis. And what it shows is how many months of operational expenditures the MFIs can cover with the cash and liquid assets that they have on hand. And on the right, you see my recreation of that same graph using pulse survey data from during crisis. And we don't want to overinterpret the comparison. The samples are different, but what we see is certainly liquidity buffers that are no lower than the pre-crisis levels, and if anything, they're actually higher. So I think it's a fair conclusion from this that there's no real evidence that we see of a generalized liquidity crunch, at least for now. The observant will note that this says data as of end April, but the picture actually hasn't changed significantly since then. If we go to the next slide, on the left, we see 4 MFIs for which we have consecutive data points and we can track the evolution over time. We see that between end April and May, the majority of them, the liquidity position didn't change substantially. And for the ones where it did, they were pretty evenly split on whether it grew or declined. Average liquid assets of the MFIs in our sample did decline a bit in the middle, but the key ratios have actually remained intact due to things like OPEX reductions and so forth. So I think overall the liquidity situation, as far as we can tell, has remained pretty healthy and pretty stable for the time being. If we go to the next slide, we also asked MFIs themselves how they feel about their liquidity situation, and specifically we asked do you anticipate a liquidity shortage and or difficulty meeting repayment obligations in the next 90 days? And 29% of MFIs in our sample say that they do. And there's some pretty striking trends on who belongs in that category, who is worried and who wasn't. If we go to the next slide, we see that pretty clearly the smaller MFIs are more concerned about liquidity. Nearly half of MFIs with less than 10 million total assets are worried about liquidity shortage in the next 20 months. And it gets progressively less as we go up the chain of total assets. And geographically, also very striking, MFIs in Sub-Saharan Africa and Southeast Asia considerably more worried about liquidity than some of the other regions. Go to the next slide. We see that deposit-taking institutions are more worried about liquidity, even though they have more of it, and that's pretty understandable. They have obligations to their clients, they have regulatory obligations to have high liquidity and so forth. So that's not very surprising, but it is noteworthy and important, and we might get back to that in the policy discussion later. And the final factor that comes through clearly is debt levels. So what we see on the left here is that MFIs who are more worried about liquidity issues tend to have higher debt levels than the ones that don't. So MFIs that are worried are in the yes two columns on the left, and the MFIs that are not worried are the two columns on the right. And what we see is liquidity OPEX ratios are basically identical across the board, but there's a marked difference on debt. MFIs are worried about liquidity, have 2.5 times more debt relative to their liquid assets. Now, that doesn't definitively tell us that the reason that they have liquidity concerns is the debt, but it stands to reason that it could be, or it could be part of the picture at least. Debt comes into play in one more way, which you see on the right. We asked MFIs, have you discussed these concerns with your funders? Have you asked for debt moratorium with your funders? And if so, have you reached an agreement on a debt moratorium with your funders? And what we see here is that the MFIs who have secured an agreement with their funders about a debt moratorium have significantly higher liquidity ratios than the ones that don't. And it stands to reason that that is simply because they have that greater liquidity, that all those payments that they no longer need to make, they are what is helping to bolster their liquidity position. So this could be part of the reason why some of those liquidity levels are as healthy as they come across in our data, that actually the funders have been stepping in and giving that leniency. And then conversely, the MFIs who have not received that leniency are considerably lower levels and sort of approaching levels that might be concerning. All of which to say that how MFI debt is handled is going to play a crucial role in whether or not they will face a liquidity crisis. All those customer moratoria are going to expire, and then we're going to see the real impact on the portfolio. As economies reopen, they're going to want to start dispersing again, and the liquidity that they've held on to is going to drain pretty quickly. So the question becomes, are MFIs going to still be able to rely on leniency from their own funders? Are they going to be able to tap into even more funding or not? And let me stop there. Thank you very much.
Mayada, you're on mute.
Thank you. So thanks so much, Peter. So I'd like to turn now to Mrs. Pia to get a view from the Philippines. So we know that the Philippines had its own experience with issuing a moratorium, and I know that that represented somewhat of a communications extra effort on your side. We'd love you to talk through that a little bit more, and then also just give us how have the things that have just been raised in terms of the policy measures that have been taken or the effects on the MFIs, how have they been playing out in that market?
Yeah, thank you very much. First of all, thank you for inviting me here. And, the paper really, gives us it's very good for us to see that a lot of the tools and policy levers that we used in the last few months are similar to what the other jurisdictions have done. So today I'll just focus maybe on some of the items that Loretta mentioned, where I have some, unique maybe insights on how the Philippines rolled this out, and maybe talk about a little bit also about our interaction with the MFI market. So a lot of the interventions are central bank driven that I will talk about, but I think unique also to the BSP is our relationship with the MFI, even if they are not the regulated market. So I guess I just have to provide very quickly a short country context, but I think this will not be need to be extensive because we experienced the same pandemic, and the effects was really most felt when we had to go on really a community quarantine with pure lockdown of all disruptions of supply chains, shutdowns of production. And I think globally, and in the paper it was also emphasized, the most affected sector, which is the MSMEs that employ about 70% of our labor force. And the impact on the MSMEs, when the government took a first survey out of the first few weeks of the quarantine, and we already saw about 60% of the MSMEs really shutting down and not perceiving to be able to operate again if the quarantine was extended even longer. And I think the main concerns of these businesses were really lack of working capital to maintain or restart their business, all the requirements in paying taxes and their suppliers. So these were their strategies to stay afloat, was really to defer payments to government, to suppliers, to get access from loans from friends and other non-bank financial institutions. So that was according to a survey. So I'll share with you very briefly what the government did as a result. It's really 4 pillars in terms of government reaction. It's really emergency support. As Loretta said, a lot of G2P payments. There were wage subsidies given. There were social amelioration programs for most vulnerable that were given. Of course, the health and resources to fight COVID was another pillar. And then the fiscal and monetary policy actions, as well as the recovery moving forward. So in the emergency support, aside from the social payments, there were loans given to certain government financial institutions that were to be targeted to be released to MSMEs. So for example, our small business corporation was given a sizable amount to target MSMEs affected by COVID. And to date, when I last checked with them, they said they were able to automate the system. They got about 20,000, thousands of applications, which made them process the loans faster. But then I just want to highlight this case because the bottleneck is on the release of the loan payments because of our regulatory environment where they still need wet signatures in the release. So, social distancing and the limit mobility restrictions hampers them to get these wet signatures. So I want to highlight this because this is something, sounding simple, but it could really be a big problem in terms of handling, loan programs such as this. Of course, the guarantee facility was also provided so that working capital loans for MSMEs affected by the COVID could be provided. So those are just some immediate government responses. And on the central bank side, we had a cumulative 175 basis points reduction in monetary policy since February. And the idea was really to continue, to put in place liquidity enhancing measures, reduction on reserve requirements, as well as we paid advance dividends to the government for them to be able to spend on the COVID response. But I want to focus on what we put in place to stimulate bank financing for MSMEs. So the reduction in the policy rate was, of course, targeted to make sure there was ample liquidity so that the banks could continue lending. But we didn't stop there. We actually made MSME loans, new MSME loans offered at the onset of the pandemic would be considered as alternative compliance to the reserve requirements of banks. So that was quite unique in the sense that we really targeted the policy move to make sure that the banks use this for MSME lending. We've also reduced MSME credit risk weights. So credit risk weight from 75% to 50% to further incentivize lending to MSMEs. 0% risk weight for those guaranteed by the guarantee fund that I mentioned. And of course, the other relief measures in terms of regulatory relief. We also reduced the minimum liquidity requirement for smaller banks. So recognizing that these smaller banks are the ones lending to small and medium enterprises, we reduced their minimum liquidity ratio from 20% to 16%. So you will see that these policy levers and these tools were really targeted to encourage the banks and really to address the barriers so that they could continue to lend to MSMEs. And I think there are some measurable gains in terms of results. Lending to MSMEs, for example, during the enhanced community quarantine, amounted to 40 billion new loans to MSMEs just during the community quarantine period, and this is already about 7% to the of the existing loans to MSMEs. So the banks did not stop lending to MSMEs, and in fact granted these 40 billion in new loans to borrowers during the pandemic. We also were able to quantify the financial relief extended by the banks to MSMEs, and we saw that those MSMEs the banks that used loans to MSMEs as part of the reserve requirement used it for the compliance of an average of about 84 billion pesos on a daily balance basis. So we can see that the very targeted tools in fact led to increased or continued lending of the banking sector to MSMEs. But of course, I think one issue that we have to also highlight is that the MFI sector is not only within the banks, and a lot of it is in the NGO sector. And as Loretta said, while we had these requirements and these incentives and even our own rediscounting facility open to our banks, these were not available to the microfinance institutions. What I think is working for the microfinance institutions here is that they're very well organized. The Microfinance Council put together a proposal for a wholesale loan package, and they're sending this to the government financial institutions to see if this is something that they could support. So we haven't stopped this dialogue with the MFIs, and in fact we also launched our own survey to find out the current state, to make sure that we are able to see if there's any opportunities the central bank can support for the building of the resilience of this MFI sector. On the moratoria, I think similar to the jurisdictions explained, ours was granted through a law. So it mandated all credit providers to provide the uniform moratoria of 30-day extension for all loan payments that fell due within that period. And the difficulty there is that it covered all credit granting entities, and same communication issue. But I think one thing that I would like to highlight that worked is that this was consulted with the banking industry as well. So there was some consultation from the banks, from consumer groups, and to really try to craft something that would be acceptable. But of course, if it's one size fits all, it cannot be successful for all parties. So there were really a lot of explanation that needed to be done. We were, as Mayada, we were on radio stations almost on a daily basis, social media posts to clarify how to treat the moratoria. So we learned from that, and now there is a new law to be enacted that again has a moratoria. So it has some learnings, because even the MFI sectors that they talked to us and they said that this will be very difficult for the consumers, because we will not be able to continue lending, which is what they need. Yes, they need some grace period maybe initially, but what they will need is continued lending. And if you require very strict and long periods of granting grace periods, we will be constrained to continue to provide lending. And so I think that voice was heard, especially from our MFI partners as last mile providers of loans to these MSMEs. And the version now of the new bill that is to be enacted is, tries to balance some of those interests. But of course, that will still be a communication challenge, I'm sure, once that's put in place. But we hope that it has been informed by the experience of the first law. So those are just some of the initial initiatives and some immediate results and learnings that we have gained. But I also want to highlight that aside from these tools, we also have been, during this period, proactively been pushing digital. We encourage the providers to waive fees for digital payments, and there has been a really big increase and conversion from checks and ATMs to digital retail payments in the few weeks, in the few months before and after the enhanced lockdown. And we really think that these are trends that will not be reversed. So we're happy that we sometimes call this a silver lining, because even our social amelioration program, which we supported our social welfare department, also digitized their social payments. And I think as of last report, there's about 9 million new accounts created for social payments that have been paid through transaction accounts. So we see these as very significant gains that could, that will not address the emergency situation in terms of, but will build this infrastructure or the resilience moving forward, for future payments and for them to use these accounts. So we're also, looking at, we eased KYC requirements so that it would be easier to open these accounts. So it's really a holistic view of what we can put in place now, trying to respond to the emergency, but at the same time lay the groundwork for how we can make the system more resilient, learning from the vulnerabilities that this pandemic exposed. In fact, it was during the pandemic that the central bank is also now finalizing the articulation of our digital transformation roadmap. And this is really well informed by the learnings also from this pandemic. So just wanted to share that, Mayada, a lot of the monetary policy tools that we put in place, as well as the regulatory relief and other issuances, as well as the continued promotion of digital and inclusion, I think could not be overemphasized as well. Thank you very much for the opportunity to share.
Thank you so much. I mean, what a very, very comprehensive approach taken by the Central Bank of the Philippines, which has always been at the forefront and is at the forefront of our industry. So thanks for that. I just want to shift now to Klaus. GIZ works very, very closely with a lot of policymakers around the world as advisors. And I wanted to get your impression around what are the demands, what is GIZ being approached for? Are you seeing changes? Are you seeing certain trends? And just tell us a little bit more about the experience that you've had working with policymakers around the world.
All right, thanks, Mayada. First of all, thanks for having me. But also, Loretta, congratulations to this stellar report. I think it's a great piece of research, quite timely, and GIZ is very happy to be associated with this paper and the entire work stream. So we're looking forward to more out of this work stream. Regarding your question, let me maybe start with the point that Germany, specifically the Ministry of Development, the BMZ, has provided a fairly generous Corona relief package of about 1.5 billion euros. And in addition to the original budget, there might be more to come. So that's for context. There's a lot of money being spent. And the first line of attack when it gets to getting this liquidity into the market in the German system is the KfW. And that's what they've done. They've channeled about 60% of all the available funds as a first measure. That's when GIZ wasn't really active yet. And they've supported local financial institutions through credit lines, credit combined with grants, increased equity investments, but also equity-like loans. And that's all happened early, as I said, not least to support institutions where KfW has a stake. I think it's over 100. I'm not here to speak for them. I just, tell you quickly what I've seen in our neck of the woods. One question that people had was if the favorable conditions actually then were passed on to clients. And I think that question is fair. I'm not going to comment on it further. But now let me comment on what we see at GIZ's work. And so there's a few short points that I wanted to make. The first one is that we see that within GIZ, the pandemic has actually led to a significant increase in the interest of microfinance. And that's as a tool to reach the bottom of the pyramid. And we at the financial sector development practice were approached by in-house non-FSD projects that want to provide liquidity to MFIs to support them, support their target group. And that's a trend that we see it's clearly. For example, we've seen it in Colombia, where there's a project that targets refugees, but money is channeled through savings and credit unions to the target group. And also another example is in Senegal, where the same thing happens. Liquidity goes to MFIs and they then on-lend it to SMEs. Of course, in GIZ, that all has to be grants. We're not a bank. Also, some of the ideas were not so great, but the fact remains that demand for microfinance as a tool for donor projects increases. And so after years of promoting microfinance to the aid community, now the aid community let us know their expectations of microfinance. So I thought it was a new twist in the story. So the next point that I wanted to make is there is politics in all these policies. And that might be an obvious point. Let me explain to you what I mean. In some markets, there is a lot of liquidity provided by donor organizations. And what we see is at a certain danger that this money is politically steered and might not go to the commercially viable institutions, but for example, state-owned financial institutions that might not have been in good shape to begin with and now are being shored up with cash and possibly even a new mandate. And so an example that we've seen is, I'm not going to name the country, but I think it's okay to say that it was a state-owned guarantee fund in Africa that was basically insolvent. It couldn't act anymore, but now it gets a new mandate, extended lifespan, is in the process of being restructured, and even gets a banking license. So we wonder, at best, this is a short-term versus long-term trade-off, right? To get money out to people and businesses quickly, but distort the market and thereby potentially cause collateral damage in the long term. So that's one observation. Another point that I felt was good in that context was the case of Tunisia. I had a call this morning with the head of the Microcredit Control Authority. And so he told me that in Tunisia in 2020, the number of extended loans by MFIs has decreased by 2/3. So that's at the extreme spectrum of everything that Peter, you mentioned in your survey. Also, there was a lot of donor liquidity in Tunisia, but the government decided that this donor money, this liquidity was gonna be lent to the health sector, and MFIs do not lend to the health sector. So they basically didn't get any of the money. And so they have to continue to refinance themselves through the market. So the point is that the distribution of donor liquidity also is a political decision. And that's influenced by several factors. And in Tunisia, it was who needs the help most. And in that case, it was the leasing companies that benefited. But also, I think the image of microfinance in MENA is just a little bit of a mixed picture when it's political. Sometimes one might lose. There also was a sort of moratorium in the country where the risk classification was frozen at a certain date. And so that avoided higher loan loss provisioning, but that rule didn't really increase the provision of credit by the MFIs. So the operational risks were higher than the credit risk because there was a complete lockdown. Refinancing costs remained unchanged. And so what happened is that the MFIs pushed their clients to pay back, and that led to an actual pronounced increase in complaints by clients that felt wrong. So this is an example where, you know, like a lack of liquidity actually trickles down to the bottom of the pyramid, actually affects individuals. And so maybe at the last point that I wanted to make here is that we've also seen liquidity of agents. Just because you mention it in the paper, I think it's an important point. We have a project in Mozambique where we see agents struggling very much with liquidity. The amount of transactions is down by 50%, and there's hardly cash-in transactions and also insufficient support by principals. And so now there's voices that want the central bank to change the incentive schemes, improve commissions. But I've seen in other markets, commission schemes by agents are complicated. I'm not sure that's going to fix the situation, but I thought since you discussed exactly the same thing in the paper, this might be an interesting point for this audience.
All right, great. Thanks so much. You raise a lot of issues. Hopefully we can get to it in some of the next phase of the discussion. So just a quick, where are we? So the paper talks a lot about the role of moratoria and how it's had very mixed results, confusion, and that the fact that a lot of the other mechanisms that are available to policymakers have not always trickled down to the nonprofit or the MFI sector. But we also know that the liquidity situation, as Peter mentioned from the Pulse survey, is not as dire as we initially thought. But Klaus has actually given us a couple of cases where actually, depending on the market, it may be worse than we think. We've seen in the case of the Philippines how one regulator has taken a very comprehensive view and has done a Herculean effort, let's just say, to address some of these issues. But still, there were still challenges, linked to, again, funding getting down to the smaller institutions, related to the communications related to the moratoria. And then just one other thing in terms of the nature of our business, which is politics still can interfere. I think Klaus made a really good case around that. So given all that, given this view of what's happening in the world related to the challenges that microfinance institutions are facing, so where do we go from here? I'd like to spend a little bit of time. We do have a few questions that have come in that I will pose to a few of you, but I'll just really quickly, Loretta, if you can just say, what are you actually recommending as next steps for policymakers?
Right. So the recommendations we discuss in the paper are obviously to carefully consider the appropriateness of blanket moratoria and to build some flexibility into that policy, and to also communicate that policy very clearly, and do not assume that because it makes sense to you that it's going to make sense once it reaches the public. In terms of a level playing field, we say that heterogeneity and oversight should not affect whether or how some of these financial service institutions receive liquidity. So, NBFIs can no longer be overlooked as non-systemic. They need to be considered in overall liquidity support, and maybe the central banks should really make available those facilities to all financial institutions, regardless of who's supervising them. And ideally, they would work with those supervisors. And also declare MFIs an essential service, just like banks. In some markets, MFIs were not declared essential and they were forced to shut down, whether they needed to or not. So that's a big concern. In terms of coordination, relief for the MFIs is needed from the greater microfinance investment community. It was very difficult to get any information about what they were doing and whether they were providing any of that liquidity support. Central banks many central banks, in providing support to the banks, recommended or said that they would like them to pass that money on, but they didn't mandate it. And just hoping that a recommendation does the trick doesn't always work, as we know. So they need to be a little more specific, which brings us to, targeted outreach. If there are particular sectors that you want to make sure get this liquidity support, then name them, say so. And then just improve communications generally on all national support measures. I think it's safe to say that worldwide, there has been lots of frustration at the consumer level with just confusion about where to turn for support. And then in additional measures, we discussed this in the paper, consider additional fiscal measures, and where we're talking there is with some of the smaller MFIs, you know, it might be worthwhile to look at measures like paying their staff costs for a few months while they deal with their clients. Now, granted, there are some moral hazard issues in doing some of these things, but it's worth considering because it might be cheaper and faster than anything else. And then finally, you know, regulators worldwide, and in fact, boards of directors worldwide, are rightly telling their institutions that they have to have in place business continuity plans and emergency measures. And so should central banks. I mean, this was the first of its kind in the modern financial era, but it's probably not going to be the last. So this is a good opportunity for central banks to think about everything that worked, everything that didn't, and put in place emergency measures that can be rapidly introduced for the next crisis.
I'll open it up to anyone else if you want to jump in with what do you think are priority recommendations for policymakers, given what we've heard today. Klaus?
I can start. Yeah. So you know, the first thought that I had when I read this paper was that policymakers, but also donor organizations, really don't have to reinvent the wheel in this crisis. It was interesting for me to see how much of the policy responses and also project programming was similar to our post-disaster work that deals with major natural catastrophes like hurricanes. So in my previous job, I did research for AFI, and we looked how financial sector policy could contribute to this post-disaster response. And we saw exactly the same like in the paper. Refinancing facilities, guarantee schemes, lending programs, loan moratoria, also monetary policy in some small island states. So, you know, that the tools, financial tools that can be deployed by policy are largely the same. But without having the actual evidence, I suspect that disaster-prone countries actually managed better in this crisis than non-disaster prone countries. And here is why I think that. One of your recommendations is to, Loretta, you just said it, develop central bank emergency plans, including liquidity facilities that apply to all financial institutions. And I think that's a great point. But I would extend this and maybe turn it around and say that central banks should play a pivotal element in national emergency plans. So it's, in short, not put the emergency plan into the financial sector, but I would put the financial sector in the emergency plan. It's a bigger picture that we're seeing right now, and here's why I think that is the case. We can learn actually from the post-disaster experience. And when Fiji was hit by Hurricane Winston, and we were there, it wiped out almost half of GDP. So small island states know what it means to have a disastrous economic shock. 50% of GDP gone. So in such a case, national coordination of the response was of the essence. And I was struck at how well the Reserve Bank of Fiji coordinated with all the other relevant ministries, like the Ministry of Finance and Social Welfare. And so a response to such a catastrophe can only be managed if all agents collaborate, but also have detailed protocols to follow. And that would start by defining what is an emergency, triggers for the begin, triggers for the end, geographic dimensions, and then go into details where the money flows. So I think, you know, like a crisis is an opportunity to design such a protocol, but I think that would be good to have. Would be good to have. The central bank here, in my opinion, is not in the lead, but they support. And maybe to this point, a last thought. We've seen so many countries come up with national financial inclusion strategies, where it's the central bank, but that they also liaise and have coordination mechanisms with all the other relevant ministries. And I think these coordination mechanisms where ministries already talk to each other, they could be a starting point for such a coordination, a crisis coordination body or whatever it is. I think that could be used as a starting point.
Great. Pia or Yeah.
Yeah.
Pierre,
Maybe
Peter, do
just
you want to jump in?
Yeah, if I may just make some comments. I think the comment on the moratoria is I think is on point, and also the timing. This pandemic has been, at least in the Philippines, I think we're one of the longest lockdowns that have been declared, and the moratoria may have been an appropriate tool immediately at the onset. But stretching it, the timing and the application of this should really be calibrated, and it definitely should not be one size fits all. And what I'm hearing from the MFIs now is they're asking, with the new law, will we be able to collect from clients who want to pay? So they had that experience that they were scared to collect because of the mandated moratorium, but then clients already wanted to start repaying. So those kinds of considerations. On the level playing field, I think in the Philippines, you're right. MFIs had to be declared belatedly as essential services, and this was because of some coordination with the MFI industry. Initially, it was just banks and remittances in terms of financial services. So I think that is a big recognition about the essential services of MFIs, particularly in the last mile. On the liquidity facilities, you're right. The central bank facilities are limited to the banks and even banks with microfinance operations, but the government also has some programs that are meant to be on lending to MFIs, and this is very well intentioned. But what I'm seeing and hearing from the market is that there are some policies with these programs that limit either the pass-on rate that they can charge to their clients, and MFIs are very much averse to those kinds of policies that may distort their how they're delivering their credit to their clients. And so that is one issue, one concern why they're not quite open to access these programs that the government is putting in place for MFI. So some review on that could be made as well. And finally, the comment in the paper on coordination and communication, I think, needs to really be highlighted, especially in a pandemic like this, which is really primarily a health issue, and yet there are so many other interests and policy areas that need to be addressed. I think confusion is the default and so extra care in terms of coordination and communication. What I appreciated, for example, with the central bank, our governor really put in place a regular conversation with the press, a weekly one on talking about all the initiatives. He wanted us to always put out the things that we are doing just to make it clear. And I think this has provided some clarity and certainty, at least for the financial services sector. And we also launched our chatbot during this pandemic. So, that's also one way where we got a lot of complaints on the moratoria, and we had to try to answer all of that. And equipping ourselves to respond to that is also necessary. So I think these are, recommendations that we really need to look at, particularly about looking at the systemic nature of MFIs and maybe looking at the liquidity facilities. I think that's something that is worth further study. And thank you, Loretta, again for putting all of this in
Thank you so much.
paper.
Thank you so much. We do have 5 minutes. We have a few questions. Peter, do you have a 30-second recommendation? Because I want to give you guys some questions.
Yeah, no, just not a recommendation actually. So just to say, all the recommendations make a lot of sense to me, and they fit very well with CGAP's on these issues. We are not actually making specific policy recommendations because every context is different, and as Pia said, there is no one size fits all. We think regulators and policymakers are best placed to see what their market needs, but we are articulating a set of sort of 5 principles that we think policy measures should adhere to. And those of you who are interested can sort of keep an eye out for that, and we can maybe share something after the call where people can read more. But as long as sort of the policymakers, the regulators adhere to those principles, we think they will come out with the best sort of outcome for clients, for the MFIs themselves and for the local economy. And the 5 principles are that they should always remain pro-poor and really focus on that overarching priority of protecting small borrowers and depositors, which means making sure that they're inclusive enough. Maybe they need to be tailored to poor people. They need to ensure consumer protection, which Klaus referred to, and so forth. It includes being clear and predictable on scope, application timelines, et cetera. As it's been discussed, this has been a little bit all over the place, and there's still a lot of things unclear in many countries, including conflicting guidance between different levels of regulation. The level playing field and the broad coverage is the third principle to ensure that there really is fair access to support for everyone, including smaller institutions and those that serve the poor. Part of the challenge there is regulatory fragmentation, which we've touched upon, which is an issue in a lot of markets that a lot of MFIs are non-banks, and they're just supervised by other entities with different mandates, priorities, capabilities, and so forth, that sort of result in unequal treatment. Fourth, that you need to sort of strike a balance between the benefits and risks of any regulatory changes. So on the one hand, you want to provide leniency and relief today. On the other hand, you don't want to undermine core long-term priorities around soundness, repayment culture, transparency and consistency in reporting, and so forth. So that's difficult. There's a difficult trade-off between what's good for clients and the fight. And then there's a point around supervision that while we need to sort of reduce supervisory pressure in certain ways, we also need to increase essential monitoring in other aspects using a sort of a risk-based approach. So while we don't give specific policy recommendations, we think if policymakers and regulators adhere to those 5 principles, and they can't really go wrong, and they'll come up with better outcomes for all stakeholders.
Right. Well, thanks so much, Peter. So we had one comment from Nepal that actually gave an example how in their market they did not see decreased bank lending to MFIs precisely because it was part of the priority sector. So it was targeted and named. So that's a good case to highlight. There are 2 questions related to digitizing payments. One is a little bit more controversial, which is, as governments have shifted towards cash transfers and digitizing payments, is this actually hurting the microfinance industry? So I'll leave it up to whoever wants to answer that one. And then linked, another issue is for Pia specifically around what did you do related to Aml Kyc? How did you simplify this? What specifically did you do? And as part of the initiative that you did. So should we start with that one, Pia?
Okay, yeah, thank you for that. Actually, our current KYC is already risk-based and recognizes reduced due diligence for low-risk accounts. But we took that a little further for this pandemic, where we actually waived the requirement for an ID if the opening of the account was to receive the social transfers and social payments. So that was really targeted for the pandemic, and that's what helped us also with what I reported earlier about the digitized social transfers. And if I may, Mayada, I don't think it's in conflict with the work of the MFI. I mean, the nature of the payments is very specific, as an emergency relief, and also for wage subsidies for those who lost their jobs due to the lockdown. The MFI's role as a continued provider of financial services will really continue to be there. So I think if ever, it's even supportive for the work of the MFIs.
So we are unfortunately on the hour. There was one other question which would have, if you guys want to stay around for 2 more minutes, it is very interesting. Someone is asking around the moral hazard issue related to the moratoriums. What will happen as the crisis comes to a close? Any thoughts on this? Yeah,
I mean, obviously, moral hazard is a huge issue. It is something that policymakers absolutely have to pay attention to. I think it's useful to point to Egypt in this case. Egypt's regulator, not the central bank, but the regulator for the MFIs, chose to institute a partial moratorium where it would only go, clients had to repay up to 50% or they could be relieved of up to 50% of their normal payment. And the regulator's view was that this would not only help the MFI stay liquid, but it would also help maintain the borrower culture that they had worked so hard to build up over the last several years. And so I think that kind of flexibility will relieve some of the moral hazard. I don't know what the answer is to those that put in place blanket moratoria, because I mean, worldwide we're seeing strife, and even here in the US there are already protests going up because of eviction moratoria are coming to an end, and you know, it's an issue. It's a big issue.
All right. Any last thoughts from the panelists? Otherwise, we will wrap it up. Oh, great. Well, I want to thank all of you for joining. This was super interesting. There's so much more to unbundle on this topic. There's so many other things to cover, and I just want to flag that CFI will be doing more webinars and more papers on different issues in the policy space related to COVID-19 and the inclusive finance industry. So look out for those. But really, thank you so much for Pia, Klaus, Peter, and Loretta. It's been a pleasure having you, and thank you all for joining today.
Thank you. Thank you, Mayada, for inviting. Bye,
Bye-bye.
Klaus, Peter, Loretta. See you.
Hi, Pia. Thank you.
Bye.
Thanks, everyone. Thanks for inviting us.